Welcome everyone. Today we begin our complete trading course. No matter your background, no matter where you live, by the end of this series, you will understand the entire world of trading from the ground up. Let's start with the most important foundation. What is a stock? Because if you don't understand this clearly, every advanced concept becomes confusing. Understanding what a stock really is. Think of a business. It could be a small shop or a large company. Every business needs money to grow for equipment, staff, expansion, research, everything. Now, instead of taking loans, a business can choose to divide itself into small units called shares. When you buy one of these shares, you become a partial owner. This is not a theory. It is literal ownership.
Let's say a business has 1000 shares. If you buy one share, you become one of the 1000 owner. If you buy 100 shares, you own 10%. Why share prices move? Share prices move only because of one force, supply and demand. Think of it like a marketplace. When more people want to buy than sell, price rises. When more people want to sell than buy, price falls. There is no magic, there is no secret formula, it's pure buying and selling pressure.
Primary market versus secondary market. This is essential to understand. Primary market. This is where a business sells its shares to the public for the first time. People invest directly into the business. Secondary market. This is where traders and investors buy and sell shares from each other. The business does not get any money here. Traders exchange shares with other traders. This is the market you trade in daily.
Purpose of the market. The purpose of the market is simple. Give businesses access to capital, give individuals access to investment opportunities. Everyone benefits, but only if you understand the rules. In this video, we go deeper. How does trading actually work behind the scenes?
The trading ecosystem is made up of buyers, sellers, traders, long term investors, large financial participants, liquidity providers, regulators. All these parties interact to create a functioning marketplace. How a trade actually executes. When you place a buy order, your order is sent to the market. It enters the order book. The system looks for a matching sell price. When a match is found, your trade is executed. Every trade requires two sides, a buyer and seller. The order book explained simply.
The order book is a list of buy and sell orders in real time. Buy orders are arranged from highest to lowest. Sell orders are arranged from lowest to highest. Where these two lines meet, trades happen.
Cash versus margin accounts. Cash account. You trade using only your own money. Margin account. You trade using borrowed money. This increases buying power but also increases risk. Margin can multiply profits, but it can only multiply losses. Now that you know how trading works internally, let's move to the most practical part, order types, the tools you use to trade effectively. Orders type decide your control over your trade. Using the wrong order type at the wrong time can cause big losses. Market order. A market order tells the system, execute this order immediately at the current best price. Pros, very fast. Cons, you may get a slightly different price than expected. Limit order. A limit order tells the system, execute this order only at my price or better. Pros, full control. Cons: it may not execute if price does not reach your level. Stop loss order. A stop loss order protects you from big losses. For example, you bought at 100, you set stop loss at 95. If the price falls to 95, your shares are automatically sold. This is essential for survival. Stop limit order. This order activates at one price but executes only at your limit price. It gives extra control but can sometimes fail to execute in fast markets. Example, you buy at 100, set stop loss at 95. Risk is fixed at 5 units per share. This is how professional traders operate. Candlesticks, your market language. Candlesticks are the language of price. If you learn to read them, you understand the market's emotions. Anatomy of a candle. A candle shows opening price, closing price, highest price, lowest price. Upper wick, price went up but could not sustain. Lower wick, price went down but buyers stepped in. Bullish versus bearish. Bullish candle is equal to buyer's win. Bearish candle is equal to seller's win. Important candlesticks to master. Number 1. Doji. Indecision, equilibrium, no clear winner. Number 2. Hammer. Long lower wick. Buyers strongly pushed price up. Number 3. Shooting star. Long upper wick. Sellers to control. 4. Engulfing pattern. Strong reversal signal. A large candle absorbs the previous one. Psychology behind every candle. Ask yourself who won, buyers or sellers? How strong was the win? Did the losing side fight back? The mindset transforms your analysis. Support and resistance. The framework of trading. These two concepts can transform your trading more than any indicators. Support. This is a level where price stops falling because buyers step in. Resistance. This is a level where the price stops rising because sellers take control. How to draw level correctly? Identify areas where price bounces multiple times. Mark zones, not single lines. Use recent data more than old data. The more touches, the stronger the label. Breakouts and fakeouts. A real breakout is equal to strong volume and candle closing beyond the label. A fakeout is equal to price breaks but quickly returns inside the zone. Pullbacks. After breaking a label, price often returns to test it. This is the safest entry for many traders.